This is Maestro Minute, the show that discusses all things real estate, sharing interviews with the most successful people in the industry. Hear from their perspective and what they are doing to achieve success. Get exclusive tips on how you can also succeed in real estate. Maestro Minute is brought to you by Maestro Development. Here's your host, Nareg Muradian.
Hey everybody, welcome to another episode of the Maestro Minute. I'm your host. Excited today. We're here at the cigar lounge that we like to visit. And today we got a super special guest. I mean, all our guests are special, but today I've been looking forward to this interview for a long time.
Me too.
Zach, thanks for joining us.
Thank you for having me. I'm really excited to do this.
Zach is the founding partner and CEO of Prosperity CRE, a private equity firm specializing in providing passive investment opportunities in multifamily apartment complexes, which we're going to talk a little different ways about that today. So super excited about that. You oversee a pretty large investment portfolio, advising and assisting clients who invest with Prosperity. So looks like you have a wealth of experience and knowledge. You've owned and operated residential real estate, mortgage brokerage, escrow, offices in both all of California, North and South, and you've assisted in purchases, finance, sale, all that great stuff. So super excited about our conversation today.
Yeah, me too.
Did I miss anything on your introduction?
No, I think that you did a great job. I'm also an attorney.
Okay.
That's how I got started in my, out of law school. I practiced law for about 7 or 8 years, doing both litigation and transactional work. But I was always passionate about real estate and investing in real estate. So eventually I made the transition over. So I still hold the license, but I don't represent third parties as an attorney at this point. I'm just full-time real estate investor and assisting others in investing alongside us.
Oh, awesome.
Yeah.
Before we get into it and dive deep, I think we should light our cigar.
Let's do it.
Today, I think we're both doing Davidoffs, right?
Yes.
I got a good Millennium one, a little torpedo. What
I got an Anniversario. I think this is like a Robusto size, right?
Nice. Yeah.
Yeah.
All right. You cut yours first. I'll give you the first cut. This should be pretty good. I'm excited about this.
Yeah, me too.
I haven't had a cigar in a while, so this will be pretty fun. And I find that the conversations that we have always get better with cigars. Maybe next time we'll have some scotch with it, right?
Oh yeah, I love that.
You started off in the legal side.
Yeah.
And what triggered you to get into switch and jump into real estate?
My even before law school, I was really into real estate. I didn't own, but my grandfather owned real estate. He owned a lot of single tenant, triple net lease properties, Rite Aids, Payless Shoe Source, those types of stores. And, I always was interested in that. Uh-huh. And then when I went to law school, the real estate class was probably my favorite class.
Okay.
So after I got out of law school and I was practicing law, sometime in I think it was in the early to mid 90s, I got that broker's license and I started doing loans on the side, just as a side hustle.
How long were you practicing before you started that?
So I started practicing in 91. I'd say maybe around 95.
Okay.
I got the broker's license and I started doing loans.
Sorry, what kind of legal advising were you doing? Was it real estate related?
Some of it was. I worked at a mid-sized firm in downtown LA. We had about 50 attorneys. And at that size, you're a little bit of a jack of all trades. You're doing whatever comes in. When I first got out of law school, when you go to law school, they don't teach you how to practice law. It's very theoretical. You learn case law, statutes. You don't really learn the practice of law until you get out into the field. And so the way I learned, one of my big clients were the Nederlanders, a family that owned and managed a lot of the entertainment venues in Southern California. The Greek Amphitheater, the Pantages Amphitheater, Irvine Amphitheater.
You represented them, that's great.
Yeah. So as a new attorney, I handled all the slip and falls. So we defended all of the venues for accidents, personal injury accidents that would happen at the venues.
Man,
so
at the Greek, there's a lot there.
Oh yeah, and those guys, these kids like to party.
Yeah. Oh yeah, I think I fell there a couple times.
Right.
So you saw an opportunity to get on the real estate side, on the brokerage?
Yeah, yeah. So we had some real estate law that we did, some land use law that we did. And so I got some experience there as well. But eventually with the broker's license, I was able to start doing loans. And I got hooked up with this local real estate investment group. And their main thesis was to buy single family homes and rent them out and sit on them for 10 years. So the basic premise was back then you could buy a brand new 3-bedroom, 2-bath house for $100,000. And back then you could get non-owner occupied financing over 90% loan to value. So you could buy a brand new 3-bedroom, 2-bath house in like Florida or Arizona, in Phoenix or Utah for $10,000 and rent them out and be cash flow break even. So the premise was if you have $100,000, you could do that 10 times. And if you sit on it for 10 years based off of average market rate appreciation, over the course of those 10 years, your equity of 100,000 in those 10 homes would appreciate to $1 million. So it was a way to convert 100,000 into $1 million.
Wow.
But because the premise required you to buy a lot of properties, I was working with investors who were buying lots of single family homes. So we were doing a lot of volume. So that's how I got started. And along the way, I started buying homes. And that was my entrance into real estate.
And how long did you do that before you went 100% into real estate?
I didn't go 100% in until I'd say about 2010, 2011.
I mean, the economy was pretty strong back then, right?
Yeah. Come back from the Great Recession and things were really starting to get going. So I came back into real estate, and at that point, I didn't have the brokerage companies or the escrow company, and I was coming in as an investor. And I did my first syndication where I brought in passive investors, and that was a 72-room hotel that we bought in Austin, Texas. And it was one of those airport hotels where we had shuttles taking people to and from the airport.
Was this through Prosperity, or this Prosperity was not established by the...
Prosperity didn't exist yet.
Okay.
It was kind of my first foray. And
Okay.
at a prior company, which I still have, and it's my partnership in Prosperity called Cornerstone, and it was through Cornerstone.
So your first kind of big real estate investment was a 72-room hotel in Austin, Texas?
Yep.
Wow.
Yeah. And it was a handful. Owning a hotel is like owning an apartment where you have all new tenants every day.
Wow. Right.
So it was a lot of management, very management intensive. We did very well with it. Austin is a great city for hotels because there's always something happening in, you have Austin City Limits,
Right.
South by Southwest. You've got the Circuit of the Americas, Formula One. You've got UT Austin, football. It's the state capital. So there's always stuff going on there. And so because of that, it's a great location for hotels.
As far as investment goes, I know Texas has, advantages and disadvantages.
Yeah.
But you guys focus a lot on that area in the South? Or is
Right now, we don't have anything in Texas. It's a good market, especially certain markets. Like right now, Austin's not a good market. It's too inflated to go in as a new investment, especially for what we're looking for. Dallas-Fort Worth is a good market if you can find something that pencils out. Houston is tough because of the insurance issues because of climate change.
So that was your first thing. And then at some point you launched Prosperity. But for a lot of the people watching today and they want to get into investment, what's the best way you recommend for them to start getting into real estate and investing?
Yeah, there's a couple ways you can do it. You can do it like I did it, where you're buying a single family home and renting it out. A lot of people are more comfortable doing that. What I found, and the reason I switched to commercial properties, is there are a lot of advantages to investing in commercial properties, larger properties, that you just don't get when you buy a single family home. There are significant tax advantages. There's huge advantages in terms of the way you value the property and the way you can force the appreciation so that you can make a lot more money in a shorter time period. And then there are economies of scale, and there are significant advantages with respect to getting best-in-class property management companies to work with, which you definitely don't get when you're just getting a single family home. So you can go the single family home route, And there are advantages and disadvantages to that. The other way to go is to invest with a firm like ours. So we have we're a private equity firm, and our clients are passive investors. They invest with us, and we handle everything. And that way they're getting a piece of a really high caliber, best in class, multi-million-dollar property. And they don't have to worry about the tenants, toilets, and termites. We're handling all of that for them.
What do you think is I guess the answer is you can start investing in real estate, and commercial is definitely more there. You have more benefits there, potentially even bigger returns. How do you qualify? You have there's Prosperity, there's a lot of other firms out there. How does someone feel comfortable with the firm they're approaching?
One of my main pieces of advice that I give people are how do I find the right firm? Take your time, do your due diligence, really get to know the product, what the offering is. Is it ground up construction, or is it what we do, which is value add? We're buying existing apartment complexes where the rents are below market, and when we're coming in and doing things to upgrade the units, upgrade the common areas, increase the net operating income, that increases the cash flow that the investors receive, and it significantly increases the overall value. So you need to understand the strategy, that the firm's employing, the types of properties, where they're located, what their track record is, and really get to know the principals of the firm, who's going to be running the deal. And that's much more important, in my view, than in the returns that they're projecting, because you could say the returns are, or whatever you want to say.
Right.
But it really, I focus more on who's behind the deal, who are the general partners, versus what are the supposed returns that you're going to receive.
And you guys do 100% multifamily?
Right now we're focused on that. So we still have a couple of industrial flex office parks that we bought about 6 years ago. Great properties. They're located in St. Louis, really good areas of St. Louis, Creve Coeur, Maryland Heights. Industrial flex office parks are single story, showroom or office in front, warehouse in back. Because they're single story, they're not necessarily the highest and best use for a new piece of property, so they're not building a lot more of it. So they're in very high demand in certain areas, including St. Louis. So we have 2 office parks that are industrial flex office parks. They're multi-tenanted. All the tenants are triple net leases.
Are those tenants typically, is there a certain type of business that you see occupying those, or is it just a mixed bag?
They're higher level, so they're not the type of tenants who are auto shops or doing auto related work. They're higher end. So, for example, one of our tenants is a very large hedge fund, and they have several floors in a nearby Class A office building. But because they're a hedge fund and they're publicly trading, they're required to have an emergency relocation site in the event of a hurricane or COVID. So what's interesting is they had a huge space in one of our parks, and their space was built out very nicely. It was all office, no warehouse, and it had satellite and all the terminals and conference rooms, and it was their relocation site in the event of a natural disaster or other emergency where they had to relocate. Another tenant is probably the biggest event coordinator in St. Louis. They put on a lot of weddings and other
so they
big
need
events.
the storage and stuff, right?
Yeah, so they're using the storage. They have showroom in front and storage in the back.
Yeah, furniture, all that stuff,
Yeah, so all the display stuff they bring to the events. And so that's another tenant. U.S. Geological Survey, they're a tenant. So it's a good mix of tenants.
So you have a little bit of industrial, but mainly mixed or multifamily.
So now we're focused on multifamily value add. One of the reasons we're focused on that more than these industrial flex office parks is the velocity at which we can increase the value. On the other hand, with multifamily, where the rents are below market, we're coming in and these leases are typically annual leases. So as soon as the lease is up, we're replacing a certain number of the tenants. We're vacating the units, we're upgrading them with higher finishes, and then leasing them out at much higher lease rates. Within 2 years, we can cycle through all of those units and significantly increase the NOI, and that significantly increases the value of the property. So we can cycle in and out of a property in 3 to 5 years. So the velocity of increasing the equity is just much faster on this value add strategy for multifamily.
And are you guys typically holding for a certain period of time? I know it fluctuates depending on, the business plan and the pro forma and all that.
Exactly.
Right.
When we underwrite the deal, we're looking at it strategically each year. When is the optimal year to exit? So, like on our current deal in Greensboro, North Carolina, it's a 5-year hold is what we're projecting. That's the optimal year to sell. We're anticipating it'll take about 2 years to go through all of those units and upgrade them, and then we'll season it for like a year. And then at the end of year 3, we'll gauge to see how the market's doing. If we can meet or exceed what we're projecting the returns will be for our investors, we'll look to possibly take it to market. But if not, we'll hold it to year 4, year 5. And then on the other hand, if the market's doing crappy, and we can't get what we need to get, we can hold it longer. We've got fixed long-term Fannie Mae debt on it. So we could hold it and look to sell in year 6 or year 7.
So you guys are making those decisions. The investors are reaping the rewards of your decisions, basically.
Yeah.
And at the end, hopefully they get the home run reward, right?
Exactly.
Everyone wins.
Yeah.
Do you have an example of a deal you worked on? I don't know if you want to talk about it.
Sure.
But something that, hindsight lessons learned, like you're like, oh, you learned a lot from it, which is great, but you probably shouldn't have invested into it. Is there anything out there that you've done?
Yeah, I'll tell you about my worst investment. When I was a broker, as a real estate broker, mortgage broker at an escrow company, everything was going great. I bought a trailer park, a mobile home park in Yuma, Arizona. You know how I said when passive investors are looking at deals, they shouldn't just be focused on the returns?
Right.
I was highly focused on the returns. And I was looking at, on paper, the cap rate was so high. It looked like it was just going to be a total home run. But what I wasn't focusing on was it was really a Class C property in a Class C, maybe C minus neighborhood. And so the management was just insane. Like the ongoing issues that I had to deal with were just something that I wouldn't want to do again. And then the other thing was it was in Yuma, which there's no easy way to get to Yuma from here. And so it was like, I don't know, a 5-6 hour drive, and I was going out there frequently to oversee management.
Is that a symptom of that type of product?
It's one of the reasons I shy away from looking at mobile home parks.
Yeah.
I mean, I know people have done really well, like Sam Zell, like just killed it in mobile home parks, but they were higher end mobile home parks. Because of that, I don't like to invest in Class C properties. And my view of mobile home parks is, if you look at the tenant base, for a lot of, not all of them, but for a lot of them, you're dealing with the lower end of workforce housing tenants. And so, as we maybe go into a recession, maybe not, those types of properties may suffer a little bit more, have more bad debt, have more economic vacancy.
You guys are mainly investing in what areas now, and what areas are you guys are located in Los Angeles.
Yeah.
But what areas are you guys, picking up property?
Yeah, so everything we invest in is outside of LA, outside of California. We're going to areas that are landlord